Does it feel like your dollar is purchasing less and less by the day? Is the economic data even making sense? And is the steady erosion of your purchasing power putting your retirement at risk? More importantly, what can we do about it? How can investments in safe haven assets like physical gold and digital decentralized technologies like Bitcoin be used to counterbalance this constant erosion of our purchasing power? If you think that you may be falling short of your retirement goals, see the link in the video description to the free inflation and retirement calculator to discuss why gold works, why fiat currencies ultimately fail, and why gold and other scarce assets act as an insurance policy against risk. We will hear from economist, White House advisor, and author Jim Rickards, author and economist at George Mason University, Lawrence H. White, economist and investor Keith Weiner, and macro analyst and investor Lyn Alden.
Going forward, gold is likely to see a little bit of a bid in terms of the percentage of the total world assets that are in gold. I mean, even if it just goes up from, it's a tiny base, so it can double pretty easily. Macro backdrop certainly favors scarce assets. I mean, the amount of debt in the system, the demographics of the system, and technology growth are deflationary. But the policymaker response to that, the large deficit spending financed by central bank, reserve creation, that's kind of an inflationary reaction to those deflationary forces. And so the things that normally benefit from that are scarce assets. So, in an inflationary environment, real estate does well, commodities do well, bonds and cash do poorly. But I think the first step is to make sure you have exposure to some of those scarce assets, things that have kind of intrinsic value, whether they're real estate, whether it's key commodities like copper or uranium or nickel or silver, things like that. Gold for some investors. Basically, it's a claim on something of intrinsic value.
You know that 99 point, I don't know what it is, 7 would my guess, percentage of Americans don't have any gold. And we're making a value proposition and saying, look, you should consider owning gold for reasons X, Y, and Z. The reason X is, we're going to have a Mad Max end of the world. It's not a real attractive value proposition. I'll just leave that at that. We should all be thinking about how do we avert this catastrophe rather than how to plan to, I'll put scare quotes around profit from this coming catastrophe. So I studied economics under this old Hungarian professor named Fekete, and there was somebody else studying at the same time that I was, another Hungarian, this other guy would have been 10 or 11 years old, and his family was trying to escape to Austria ahead of the Soviet tanks. They got to the border, and there were guards there, and the father had a gold wristwatch. Not a paper claim to gold, not GLD ETF gold, not gold futures, not, whatever, but an actual chunk of gold. And he took the watch off, and he handed it to the guards, or the captain of the guard, and the guard said, I didn't see you, you're not here, but get lost, because if you're here in 10 more minutes, my men are going to shoot you. And then he deliberately drove off in his Jeep or whatever it was, and they had 10 minutes to get to the border, which was, half a mile away. So they escaped because they had physical gold. That said, so gold may afford you a life-saving option to get out of where you need to get out of, but it may not avail you. So you're better off with gold than without. We should all be thinking about how do we avert this catastrophe rather than how to plan to, I'll put scare quotes around profit from this coming catastrophe.
I'm not talking about e-gold, I'm not talking about COMEX futures, I'm not talking about GLD, I'm not talking about ETFs, I'm talking about gold. So gold is no one's liability. I think no one's done a better job than the Austrians of pointing that out. It's the only form of money that's not a liability. I learned in the first week of law school, if you have a contract, you're supposed to read the contract. Take a dollar bill out of your wallet, or take a pound sterling, and look at what it says. Look at the writing, that's the contract. It says it's a note. It's a Bank of England note, or in the case of US dollars, a Federal Reserve note. Where I went to law school, a note is a liability. Indeed, if you look at the balance sheet of a central bank, the money that they've created is listed on the liability side of the balance sheet.
We found that real stability in the economy hasn't been any greater under the Federal Reserve, even if we confine ourselves to post-1971. True, they screwed up in the Great Depression, and so if you add that in, then the Fed's track record is even worse than the classical gold standard in terms of output stability. It's often thought that the Fed is needed to backstop the financial system in the event of panics, natural disasters, pandemics, that without somebody there to make the printing press go burr, that there's going to be a lack of confidence that everybody can get their money when they want it. Biggest piece of evidence I can offer in this regard is that the Canadian banking system, which had no central bank, which had no deposit insurance, weathered the Great Depression without a single bank failure. The economy suffered because The U.S. is their biggest trading partner, so they could hardly have not had a depression in output, but they had no financial trouble. They didn't have any bank failures. The problem with a lender of last resort, again, is a moral hazard problem. In a sense, it underprices the assurance that it's giving, and thereby creates an incentive in banks to take on bigger risks than they would if they were bearing all the costs themselves.
It's a little bit like fire insurance on your house. You don't want your house to burn down, but heaven forbid if it does, you're sure glad you have the insurance. And when you write that premium check to the insurance company every month, you don't think you're throwing your money away, you think you're doing a smart thing. So get some gold, it's volatile, don't get too upset with the day-to-day price action. But institutional allocations are about 1.5%. So I'm recommending 10, so there's a long way to go there. People need to get a lot more gold. I would see it sort of chugging along with a lot of volatility, and then I think we're getting close to the stage where it's just going to gap up. Meaning, one day it'll go up $100 an ounce and that'll make a lot of headlines, and the next day it'll go up another $100 an ounce and that'll make headlines, and all the talking heads on TV will go, oh, it's a bubble, don't be a fool, etc. But then, the next day, boom, it keeps going. Then what happens is then people wake up and say, oh, gee, I better get some gold. What they'll find is they can't get it. They'll call the dealer, sorry, sold out. They'll go to a coin shop, sorry, we're back ordered. They'll call the mint, we're not taking new orders. The big guys will get it, the sovereign wealth funds, the central banks, the hedge funds.
Gold is clearly on the rise and making historic highs. The 5,000-year history, gold is the one asset that has outlasted numerous business cycles, economic downturns, booms and busts, stock market bubbles, and the rise and fall of every currency. And unlike depreciating, faith-based fiat currency, gold is no one's liability. Gold IRAs provide a tax-deferred means of building wealth, storing it securely, as well as protecting your retirement and purchasing power from counterparty risk. If you are ready to start your gold investing journey, see the links in the video description to the best gold IRA companies that we have personally reviewed and vetted. To attend a free gold education webinar held by Augusta Precious Metals, see the link in the video description. Thanks for watching.